And it is time to trade. This is the Trading Bell. Good evening and thank you very much for joining us. My name is O'Brien Kimani. We are coming to you from the trading floor of the Nairobi Securities Exchange. And of course, we are here to look at how the market has performed. And of course, later on, I'll be chatting with Lamin Manjang. He's the Chief Executive Officer, Standard Chartered Bank. And we'll be seeking to know how the market has performed from Churchill Ogutu. He's a research analyst at Genghis Capital. My Twitter handle is at O'Brien Kimani. Our SMS line is 22162. And always remember to start with the word base. Right now, let's have a chat with Lamin Manjang, Chief Executive Officer, Standard Chartered Bank. Lamin.
Yes, Brian.
Thank you very much.
Most
welcome.
Nice to see you. Yeah, good to see you too.
Welcome to the Trading Bell.
Thank you very much.
Please. Good. Oh, now, basically I want to find out from you, you have been in the banking industry for 18 years, 3 years here in Kenya. When you scan the Kenyan study case, what conclusions do you make?
Thank you very much, Brian. As you said, I've been in the banking industry for 18 years, spanning about 5-6 countries. I originally come from Gambia, but I've worked in Tanzania, I've worked in Sierra Leone, in Uganda, in Oman, and over the last 3 years in Kenya. What I can say about the Kenyan banking industry, having worked in different markets in Africa and the Middle East, is that it's a very dynamic, a very strong, a very robust banking industry. Obviously, it's an industry that has been in the forefront of a lot of innovations. We have seen agency banking, for instance, really take off in a big way in Kenya. The mobile banking revolution, which obviously Kenya has been leading the way with M-Pesa, and of course how that has linked with the banking industry to provide solutions to clients with M-Shwari and so on and so forth. So it's been a very dynamic banking industry. In terms of the lending to SMEs, Kenya, for instance, has the highest penetration level in terms of banking sector lending to the SMEs, which is really a very big plus. Very good.
You know, you've used some very encouraging words there, from resilience to innovative. But when it comes to the challenge side, what are the challenges do you see?
Well, the biggest challenge that we see right now is the impact of the interest rate capping, which was passed into law last year. Obviously, that is a law that obviously was designed to bring lending rates down in the market, but the method that was used by putting price controls, by putting caps, obviously has its adverse effects. We have seen credit growth that was already slowing down, continue to slow down in the fourth quarter of last year and into the first quarter of this year. We have seen banks take decisions like closing down branches that they no longer feel are profitable, laying off staff, and really taking decisions that are really designed to make sure that if the revenue line is constrained, then you have to look at your cost line very, very severely. And I think that has really had a negative impact on the industry.
But I think it's also very correct to put it this way, that you know, when you look at the banking amendment law, it has been around for less than 5 months, actually less than 6 months. Yeah. So I don't think this should have given or formed a concrete opinion or basis for banks to start closing branches, and to start firing people. There must have been other underlying issues, which probably maybe you can bring them out.
No, you see, the thing is, if you look at the banking industry in Kenya, it's actually been quite profitable as an industry. If you look at the performance ratios of the industry, they've been quite strong. And I think that is one of the reasons why there has been a lot of interest from investors in the banking stock. We are at the stock exchange right now, and you could see that banking stocks used to be one of the biggest attractive counters from foreign investors. Ever since this law was passed, we have seen banking stocks really decline very sharply, which means investors have taken a negative view about the outlook of the industry. Now, in terms of measures that have been taken, it's not a knee-jerk reaction. The impact of the rate cap was felt immediately because banks had to reprice all loans, both the existing as well as new loans. So the impact on margins, the impact on profitability was immediate. And with that, obviously, some of the decisions around your branch network and rationalizing that, looking at other ways of gaining efficiency to be able to, you know, operate profitably, those are rational decisions. And I don't think, you know, these were knee-jerk reactions. They were reactions that were anticipated before the rate cap took effect.
And just hang on there, because we'll be coming back to that issue. You know, I like your tagline, because it says here for good, or is it here for good? Or
it is here for good, yes.
Here for
Standard
good.
Chartered here for good.
Standard here for good. And we saw at the end of last year, Standard Chartered PLC deciding to move some of their core functions from Nairobi to Chennai in India. Does that tagline still hold? Well, when you're about to retrench about 300 people?
The tagline still holds. Let me tell you why. In as much as we had announced those measures to move jobs from the shared service center, that was a decision that had been taken in light of our global strategy, that we will only have 3 global shared service centers across our footprint. One in India, one in Malaysia, and one in China. So therefore, the smaller shared service centers in Ghana and in Kenya, we decided that we were going to close them at this group level. However, just to make sure that we are here for good, we try to minimize the impact of those layoffs. So you announced, you said 300 people. But in reality, what we did was to freeze all vacancies within the bank, even before the implementation of the move, so that we take staff from the shared service center into those roles within the bank. Then secondly, we also announced a measure to try and create a voluntary separation scheme, and all the jobs that were saved from that, again, would be used to get people from the shared service center. So the net impact is actually far less than the 300 that was announced. And I think that is a demonstration of being here for good. We feel that we should make sure that we save as many jobs as possible so that, you know, those guys can continue to work in the bank.
And we expect the transfer of those services, you know, to be completed sometimes in June?
Yes.
So far, how many people have been affected directly by this closure?
As I said, the expectation is that we will save nearly half of the jobs that are at risk as a result of the measures that I have announced.
So that's 150?
Yeah, at least we're expecting around that number to be saved. So the transition is taking place, but like I said, it should be seen in the wider context of consolidation of the global shared service centers. But here as a bank, being here for good means that we are really trying to do the best for the staff that are going to be impacted.
And with the shared services gone, what will change going forward?
Well, basically, it would also drive efficiencies. I mean, these shared service and the global shared service centers are world-class in terms of technology, in terms of processes, in terms of just the sheer scale. So clearly, it will allow us to operate very efficiently, and that will also feed into some of the challenges that I have mentioned around the rate capping, that you really need to be very efficient in terms of your operations to be able to absorb some of the, you know, the impact that such a measure would have.
And we saw, I can't remember whether it was 2013, whereby you pioneered the you know, branches that are not manned. But somehow you have gone quite on that concept. How far are we?
Well, yes, you see, Standard Chartered Bank has been one of the most innovative banks in this market. I mean, we are the oldest bank in Kenya, obviously. We've been around for over 100 years. And we've pioneered a number of firsts. One of the first pioneering initiatives was the ATMs, which I think everybody takes for granted now. I mean, ATMs are all over the place. But Standard Chartered was indeed the first bank to launch ATMs in the market. We were also the first bank to launch a digital branch. In other words, a branch that doesn't have tellers, and it's fully automated. It's 24/7, which we launched at Junction Mall. We are investing heavily in digital. We believe that the future of banking is going to be increasingly digital. So we have invested in technology like the mobile app, which we launched last year, and that is so convenient that, you know, you could actually do most of your transactions, whether it's paying your bills, making transfers, all at the tip of your, on your mobile phone. We've also launched something called Retail Workbench. Now, this allows us to use the iPad, and then when we are opening accounts or selling products to our clients. So instead of using paper, you could actually have all of that done on a digital basis. So it's more convenient, more efficient, less errors, and it's all really part of our digital agenda, which is really to make banking easy and convenient for our clients.
And so what you are simply saying is that we expect to see a number of digital branches being rolled out in the course of this year, probably maybe next year.
Not necessarily digital branches, but we will have digital offerings. For instance, we are now launching cash deposit machines. Now, one of the reasons why people come to branches is when they physically need to deposit cash. You'll still need to come to a teller. Now, we have these machines that allow you to come and deposit your cash through the CDM. Now, that's again 24/7. So the convenience of these technologies is that they are 24/7. You don't have to be limited to opening hours and closing hours of a branch. So increasingly, we are going to invest more and more in those technologies. But again, it's for the benefit of our clients. It's to make banking easier and more convenient for our clients.
And when you look at your books, you have a very, very, very serious liquidity level, which is almost 3 times the statutory requirement. Sure. Why do you have all this money lying idle?
Well, we are going to invest. And of course, we are very keen to invest in the real sectors of the economy. Which is really why the rate capping has come at a bad time. Because as banks are keen to invest, like I said, in the SME sector, which is a growth sector for us, as we invest in the personal unsecured lending, which is again a growth sector, as you know, as people, of course, get into the middle class, they want to acquire, houses, they want to acquire other investments. So all of that is really, geared towards helping people, companies to grow. And the rate cap has really been negative in terms of that aspect. I'll just give you a very practical example. If you look
very briefly.
Yes. If you look at the personal unsecured lending, it's the one that has the highest loss rates. All right, because it's unsecured. So the risk is high, and you price for that risk by ensuring that you get a return on the loans that you give out. If you have a rate cap, all it means is that you'll only have the lower risk, part of that portfolio that you will lend to. So the higher risk part would be people now who would have to go to loan sharks or other avenues to be able to get access to credit.
Lamin, because we have to come to the end of this interview, but I want to give you 30 seconds for you to face that camera and you predict for us what the year holds for the banking industry in Kenya. And of course, you can also outline some of the benefits of being a listed bank.
Well, 2017, obviously, we will have the impact of the interest rate cap, which is, like I said, something that would be negative for the banking industry. But as an industry, we will adjust in terms of how we position ourselves to be able to operate more efficiently and ultimately really be able to serve our clients better. In terms of the overall outlook for the Kenyan economy, I think it is positive. We do see growth prospects in the economy, but of course we've got to make sure that the banking industry is empowered to be able to be a part of that growth story in the Kenyan economy.
Very good. Lamin, thank you very much indeed
for
joining us here.
Brian.
Lamin Manjang, Chief Executive Officer, Standard Chartered Kenya and East Africa, joining us here on the Trading Bell to help us understand what is the status of the banking industry in Kenya. This is the Trading Bell. We still have more. Stay right here. The figures according to how the market has performed in the last 1 week. We're joined by Churchill Ogutu. He's a research analyst at Genghis Capital. He's joining us to help us put these numbers into perspective. When you look at all the four markets, or the four indices of the market, they have performed negatively. What is happening after such a streak whereby they were all appreciating?
I think one of the major factors that has really contributed to this negative performance is largely on the large blue chip companies, the likes of Safaricom, which has really had a low decline in terms of its price movements here in the last 1 week here. We saw that there was this dominance report that is anticipated to come out, which has really brought about some negative impact on this counter. And being Safaricom being one of the largest companies in the bourse, its movements tend to have an impact into these four indices here. So I'm seeing that one, and also in anticipation of the numbers that you've seen so far, the banking sectors, the two banks that have released their earnings has really become negative. They have been worse than the previous earnings, so which is something that the market is looking at it, that even the other bankings that will come out, the results, it will be a bit negative. So all these factors are combining to actually depress the indices in the last 1 week. Yeah.
So according to you, it's more of sentiment driven rather than fundamental underlying issues.
Yeah, I think it's rather more about the sentiments right now. Right now, I mean, we are on to a third year of a bear run, so it's more about the sentiments here. So I think if you look at the analysis, the figures that you've seen in the last 1 week is still that continuation of the sentiments from the investors that they are looking at it, that, I mean, the numbers from the banking sector won't be that better, and also from this dominance report. So this sentiment, negative sentiment is actually weighing on the performance of the indices.
And when you look at the top gainers, you know, I'm surprised that Eveready East Africa is here, you know, moving by a whopping 13.3%. Why is this the case?
I think that one is coming on two fronts. One is the price levels that right now it is. Last week we were talking about 2 shillings and 25 cents. So it's something a bit, it's bringing on the speculative aspect into it. So investors are actually being driven towards it because of its attractive price levels. Yeah.
And out of the 5 top gainers, 3 of them are in the agricultural sector: Kakuzi, Eagard, Williamson Tea. What is happening in the agricultural sector that is making these counters to move this much?
I think the major thing that is coming out is now the low level pricing in the agricultural as a whole. Last year, looking at it from 2015, it actually was one of the best performing sectors, but last year it actually retraced some of those gains from 2015. So right now I'm seeing investors are coming into the low levels, so which somehow has had an impact onto their weekly performance. Yeah. Speaking of it, we saw that Limuru Tea actually gave out its profit warning, but this is majorly on account of its revision of one of its some of the financial numbers, some of the financial statements, IAS 16, which will, they think that it will now be able to bring some a negative impact into its earnings here. But apart from that one outlier, we think that the rest is actually somehow attractive to the investors to come on board.
Moving on quickly to the top losers, Liberty Kenya Holdings and Deacons. Why Deacon is performing this poorly, and East Africa Portland Cement?
On Portland's last week we saw it's releasing its half-year results, though it was a bit, it wasn't that good, but I think going back to it, the outlook that has actually been from the car stock is actually being depressed by the election jittery, because cement consumption won't be that positive as such, and also there's a bit of some supply overhang. So all these things coming in, and then bearing in mind that in December actually the stock actually came out and said that they lay off 1,000 of its workforce here, so it's quite a big magnitude here. So all these things have really come to depress the price levels of Portland, so it's something that is a continuation of that particular stock.
Chache, quickly, I want you to tell us which are the counters to watch in the next 1 week.
The next 1 week, I think on the account of the Safaricom coming down to its lows, right now touching 7-month lows of 17 shillings. I think this is a price level that will now attract more investors coming on board to come and jump ship and get into buying the stock. And also, we're looking at a bit of some of the numbers, banking stocks. We're yet to see some of the tier 1 banks, KCB, equities releasing their results. So, I mean, it will be a bit of some trading into that stock, yeah.
Very good.
Stocks, yeah.
Thank you very much, Churchill, for joining us here.
Okay, thanks a lot.
Churchill Ogutu is a research analyst at Genghis Capital, joining us here for a markets analysis. You're watching The Trading Bell. Please stay right here.
When you fund your money to buy the shares, then you are given back your dividends plus the returns. Do you cease to become the shareholder of that company?
No, once you have received dividends from a listed company, you do not cease becoming a shareholder of that company. Dividends is actually a way of a listed company issuing some of its profits to its shareholders at its discretion whenever it does not see any opportunity of deploying those profits into the company.
And there you have it, a comprehensive look at how the market has performed and, of course, how the banking scene is looking like right now. Thank you very much indeed for joining us. This has been The Trading Bell. My name is O'Brien Kimani. If you want to interact with us, we encourage this so much. Our SMS line is 22162. Always remember to start with the word BIZ, that is B-I-Z. At The Trading Bell is our Twitter handle, and the Facebook page is The Trading Bell TV Show. My Twitter handle is at O'Brien Kimani. We'll see you next time, same time right here on KBC Channel 1. And I'll take you back to Broadcasting House. Thank you very much.